G'day legends, welcome back to Gold Jumper, where we track the shiny stuff and keep the portfolio looking like a ripper. Jump up and under, let's get into it. Today we're dissecting the wild gold ride from March 11th to March 13th, 2026, where the charts look like a kangaroo on a trampoline. We'll be diving into the technical indicators across the 1 hour, 4 hour, and daily charts to see if the bulls are still in the driver's seat. Then we're checking out the absolute chaos in the oil markets, the US debt wall, and how you can grab some local Aussie exposure through the ASX. Just a quick reminder before we start, this script is for entertainment and educational vibes only, so chat with a professional before you go all in. Now here is the big question for today. Do you reckon gold is headed for $6,000, or are we due for a massive correction first? Let me know in the comments, smash that like button, and subscribe to join the crew so you never miss a beat on the yellow metal. Starting with the price action, gold kicked off March 11th, 2026, with a massive shove up to $5,207. The Middle East conflict was heating up, and traders were scrambling for safety like it was the last cold one at a barbie. By March 12th, the mood soured a bit, and we saw a retreat down toward $5,086 per ounce. A spike in US 10-year Treasury yields was the culprit, making non-yielding gold feel a bit heavy in the pocket. But don't count the yellow metal out just yet, because by the afternoon of March 13th, we've seen a recovery. Spot gold is currently trading around $5,119.49, up 0.79% for the day. Even though we're up today, we're still looking at a potential second week of losses, so it's a real tussle out there. The bulls are fighting to keep the price above that $5,000 psychological level, which is a fair dinkum battleground. Central banks are still hoovering up physical bars in the background, providing a solid floor for the market. It's been a high-velocity 72 hours of trading, and the volatility is enough to give anyone a bit of a headache. Let's pivot to the 1 hour chart where the short-term action is happening at a cracking pace. On March 11th, we saw a classic golden cross where the 50-period exponential moving average crossed above the 200-period line. That's usually a signal that the intraday trend is shifting to the upside and the momentum is building. The relative strength index on the 1 hour chart was sitting at 50.54, which is a pretty neutral spot to be in. It meant the market wasn't overbought yet, giving the legends plenty of room to move higher before hitting resistance. We saw gold test the $5,184 pivot point multiple times during the session. Traders were watching for a break above $5,245 to confirm a new leg up. When the price holds above those short-term averages, it gives the day traders a bit of confidence to stay long. But as soon as we saw those bond yields rip higher, the 1 hour chart started showing some signs of exhaustion. The 50-period average started to flatten out, suggesting the initial burst of energy was starting to fade. Moving out to the 4 hour chart, things get even more interesting for our swing trading legends. We spotted a Harami reversal pattern forming near the lower Bollinger Band on March 11th, 2026. For those who don't know, a Harami is a two-candle pattern that suggests the previous downtrend is running out of steam. This pattern played out perfectly, sending the price back up toward the $5,235 zone. The 4 hour chart has been respecting an ascending channel that's been in place since early February. The first major upside target on this time frame is $5,388, which would be a massive win. However, the upper Bollinger Band is currently acting as a bit of a ceiling at $5,345. Support is anchored down at $5,070, and as long as that holds, the 4 hour structure is still bullish. The midline of the Bollinger Bands is acting as a magnetic pivot point, keeping the price from straying too far. It's a bit of a waiting game now to see if we can break the recent highs or if we need another dip. Now let's look at the daily chart, which gives us the big picture view of where the smart money is moving. We are currently seeing a massive Bollinger Squeeze, with the bands narrowing significantly on March 13th. Historically, when these bands get tight, it's a signal that a massive volatility breakout is just around the corner. The price is currently oscillating right around the 20-day simple moving average, which is sitting at $5,009. But check this out. The daily relative strength index has actually dropped down to 25.67. That is deep into oversold territory, suggesting that the recent selling might have been a bit overdone. Usually, when the index is this low, we expect to see a sharp bounce as buyers step back into the market. The 50-day simple moving average is currently at $5,176, acting as a dynamic overhead resistance. We also need to keep an eye on the 200-day average at $5,172. A daily close back above these levels would be a signal that the correction is over and the next bull run has started. Let's talk geopolitics, because this is the real engine behind the gold price movements this week. We are now 13 days into the conflict involving the United States, Israel, and Iran, and it's not looking pretty. On the evening of March 12th, the Israeli military launched a massive wave of strikes across the city of Tehran. They were targeting the infrastructure of the Iranian regime and the paramilitary forces known as the Basij. In response, Iran has effectively shut down the Strait of Hormuz, which is a critical corridor for global energy. About 20% of the world's oil supply passes through there, and right now, nothing is moving. President Donald Trump has been on the airwaves saying the war could end soon, but he's also issued some stern warnings. He told Tehran not to try anything cute, or they'd face consequences like they've never seen before. This back and forth between war rhetoric and talk of peace is keeping the gold market on edge. Investors are holding onto their gold bars as a form of insurance in case the conflict spreads even further. Speaking of the Strait of Hormuz, the oil market has been absolutely mental over the last few days. West Texas Intermediate, or WTI crude, reacted violently to the news of tankers burning in the Persian Gulf. We saw WTI surge almost 10% in a single session, hitting an intraday high of $95.97. By March 12th, oil prices officially breached the $100 per barrel mark, which is a huge psychological level. This surge in energy costs is stoking inflation fears faster than a bushfire in midsummer. Higher oil usually means higher gold because investors want to hedge against the rising cost of living. The International Energy Agency, or the IEA, has called this the largest supply disruption in the history of oil. They've agreed to release 400 million barrels from strategic reserves to try and calm the farm. But the market isn't convinced yet, and oil is holding on to most of its gains despite the reserve release. If oil stays above $100, you can bet gold will find plenty of support from the inflation hawks. You also need to keep a close eye on the OVX, which is essentially the fear gauge for the oil market. The CBOE Crude Oil Volatility Index, or OVX, has spiked all the way to 121. That is the highest level we've seen for the OVX since the start of the pandemic back in 2020. High volatility in oil often spills over into gold as investors run for cover from the broad market chaos. When the OVX is this high, it means the market is expecting some seriously wild swings in energy prices. This volatility is a double-edged sword because it can drive the US dollar higher as well. The US dollar index, known as the DXY, has been hovering near 97.85, providing some headwind for gold. It's a real tussle between the safe haven bid for gold and the strength of the greenback. Gold legends need to watch if the OVX starts to cool down, as that might signal a return to price discovery. For now, the high volatility is keeping the gold risk premium firmly embedded in the current price. Let's look at the macro picture in the States, because the US is facing a massive debt wall. Between 2026 and 2028, a staggering $25.8 trillion in debt is coming due. In 2026 alone, the US has to refinance $9.5 trillion, which is a mind-boggling amount of cash. With interest rates where they are, this could add over $200 billion to their annual interest bill. This is what the experts call fiscal dominance, where the government is basically forced to keep printing money to stay afloat. Gold is being repriced right now as the ultimate hedge against the debasement of the US dollar. The Federal Reserve is caught between a rock and a hard place, trying to fight inflation while keeping the government solvent. Markets are only pricing in about a 70% chance of a single rate cut later in 2026. This high-rate environment usually hurts gold, but the debt situation is so dire that people are buying anyway. It's a structural shift where gold is reclaiming its role as the anchor of the global financial system. Even the legends over at WallStreetBets are getting in on the action, and the sentiment there is pure fire. The narrative on Reddit has shifted away from tech stocks and toward hard assets like gold and silver. You'll see posts claiming the US dollar is in its end of days and that paper assets are basically worth naught. Some of the most bullish traders are calling for gold to hit $20,000 or even $40,000 an ounce. They're calling gold the trust mechanism for the New World Order as central banks ditch US treasuries. There's a lot of talk about diamond-handing gold miners because they are currently trading at a massive discount. Many miners are sitting at less than 5 times their forward earnings, which the Reddit crew thinks is a total steal. Of course, there's always a few bears in the thread warning about a bubble, but they're getting drowned out. The general vibe is that gold is the only thing standing tall while the rest of the market is looking shaky. It's high-energy stuff, and it shows that retail investors are starting to wake up to the gold story. Now, how do you get in on this action here in Australia? Let's talk about the ASX gold miners. Northern Star Resources, ticker NST, is one of the big dogs, though they've had a tough run with some production hiccups. Then you've got Ramelius Resources, ticker RMS, which is a real growth machine with their hub-and-spoke strategy. There's also some smaller players like Torque Metals, ticker TOR, which have been putting up some massive gains. If picking individual stocks isn't your cup of tea, you can look at gold ETFs on the ASX. The Perth Mint Gold ETF, ticker PMGOLD, is a classic choice, and it's backed by physical gold in the vault. There's also the BetaShares Gold Bullion Currency Hedged ETF, ticker QAU, if you want to avoid the currency swings. For exposure to the global mining sector, the VanEck Gold Miners ETF, ticker GDX, is a popular move. Investing in miners gives you torque, meaning their share prices often move way more than the price of gold itself. Just remember that mining comes with its own risks, like operational issues or rising costs for diesel and labor. Down here in Australia, the Reserve Bank is also making waves with some hawkish commentary. The market is pricing in a 75% chance of a rate hike at the next meeting, taking the cash rate to 4.1%. High local rates are actually supporting the Aussie dollar against the greenback, which is a bit of a twist. RBA Deputy Governor Andrew Hauser has been signalling that the economy has limited spare capacity and inflation is still too high. This makes gold even more attractive for Aussie investors looking to protect their purchasing power. No dramas in the dip, just more room in the pouch if you're looking to accumulate on the pullbacks. To wrap up the main points, gold is holding steady around $5,119 after a volatile few days. The technicals show a Bollinger Squeeze on the daily chart, suggesting a massive move is brewing very soon. Geopolitics is still the main driver, with the Iran conflict keeping the safety bid alive and well. Oil prices hitting $100 is a massive inflationary signal that usually bodes well for gold. The US debt wall is a looming monster that makes the long-term bull case for gold look rock solid. Sentiment on WallStreetBets is reaching fever pitch as retail traders pivot toward hard assets. And for the Aussies, the ASX offers plenty of ways to play the rally through miners like Northern Star or physical ETFs. So legends, what's your play? Are you buying the dip or waiting for more clarity on the Middle East? Drop a comment below with your price targets, and don't forget to like and subscribe if you found this helpful. We'll be back next week to see if that Bollinger Squeeze finally pops to the upside. Stay active, stay legendary, catch ya.